Hey, what's going on, everybody? It's Monday, July 25th. How's everybody doing? All right. Well, we had a mixed close in the market today. Dow up, S&P up, NASDAQ down, but off its worst levels of the day. Gonna be a busy week, folks. As you probably know, we got a lot of data coming out. We got the Fed meeting on Wednesday. You got big tech earnings all this week. That's, I think, what's causing some of the jitters in the NASDAQ. So we'll get through this. As I've been saying, when we were heading into this earnings season, I said that even if the earnings come out on the weaker side, the stock market has basically already discounted that. In other words, it's, the stock market, because of the big correction that we've been through over the past 5-6 months, I mean, it basically has factored in a weak second quarter, weak corporate profits. And they're not all going to be weak. The Fed meeting, obviously, on Wednesday, that's going to be impactful. Looking at a 75 basis point rate hike, that's right now, I think there's something like a 78% probability based on where the Fed fund futures are trading. So, I mean, if one thing Powell has shown us, it's that he is a slave to whatever the market wants. If the market says 75, he'll go 75. If the market was saying 100 basis points, he'd go 100 basis points. I mean, this goes all the way back to his first term, when he's very easy to predict. I mean, whatever the market is saying, he doesn't understand, or a lot of these, I guess the whole entire FOMC members, they don't understand that they are the monopolists, they are the price setters, they are the rate setters. It's not the market. And whatever. The only, curiously, the only central bank that seems to understand that is the Bank of Japan, which is still sitting there with negative or 0% interest rates. They have not moved. Last week we saw the ECB go 50 basis points. Actually, that was a bigger move than what forecasters had been expecting. So they all do the same thing. This is their orthodoxy. This is their, this is how they view things. And I've spoken about this so much now. I mean, how rate hikes, they're essentially price hikes. The cost of credit is reflected in the cost of all goods and services. You raise the interest rate, that affects everything. The cost of production, the cost of financing something for a purchase. I mean, it just raises the general price level. We're not talking about draconian price increases, at least from an interest rate perspective, like what we saw back in the 70s when, basically rates went from like 4% up to 21%. But still, it's raising the price level, or it's sustaining a higher price level than what otherwise would be the case if the Fed just left it alone. And it's not going to squash inflation. If we're going to get any relief from inflation, it'll probably be on the energy side. And that's still up for discussion. I mean, I saw again in the latest CFTC Commitments of Traders report that came out last Friday, oil producers were aggressively on the buy side. And they lifted their net long futures position to the highest level since the week ending April 19th. So they're net long. These are producers. These are guys, entities in the physical market that own the physical. I mean, that is a very rare position for them to be net long. But they've been net long now, I think, going all the way back to almost for a year. And the price decline that we saw over the last couple of weeks, when we're trading now under $100 a barrel on WTI, that isn't dissuading them from, they just keep buying. So, I have to go on the side of those guys. I used to actually do business for them when I was a NYMEX member. I was a floor broker executing orders for oil companies, and they're very, very savvy. I mean, their positions may not play out in, a day or two, but they have the best feel for their commodity, way better than any speculator in the market. So just take that into account, the fact that they're buying, they're still buying, they've been buying. What else is going on? So we got GDP, we got second quarter advance GDP estimate for the second quarter. That's coming out on Thursday. Atlanta Fed has a forecast of a negative 1.6%. I said I'm pretty sure we're going to have a negative print. And if we have a negative print, that would qualify for the accepted definition of a recession. That would technically, put us into a recession, 2 negative quarters. But I will tell you that, there is some variance in that forecast. I've seen forecasts as high as like 2.5%. I don't think we're going to get anywhere near that. I've seen forecasts like just barely over 1%. I think we're going to have a negative. And the reason I say that is because of the fiscal slowdown that happened in the second quarter, and which is still happening, by the way. It's actually accelerated. If you look at the average daily government spending, that has broken an 8-month uptrend. It was a modest uptrend, but it was an uptrend nevertheless. And that just broke down recently. By the way, today's Monday, so I sent out the new edition of MMT Trader. If you want to get a copy of that, go to my website, pitbulleconomics.com, sign up for a 30-day free trial. So yeah, but the good news is, or the positive news is, the deficit is now at the highest level since pre-April tax drain at $865 billion. So again, I've always gone to that swimming pool analogy. The pool is filling back up. That is a positive, all right? And I think where the level is now, that probably indicates we're going to see somewhere around 4,250 to 4,500 on the S&P. All right? Where are we now? I think we're right around 4,000 or just below 4,000, 39 something. So I'm saying 4,250 to 4,500 on the S&P is a target based on how the deficit has recovered. And by recovered, I mean how it has expanded back to that pre-April level. That's important. The other thing I see is that it looks to me, and it may be too soon to tell, but I look at tax flows very closely, and if you go back to my videos from the earlier part of this year, March, April, May, I was talking about how tax flows were exceeding spending flows. It's now starting to look like tax flows, at least employment and withholding tax flows, and those are the biggest tax flows. I mean, 85% of the tax, revenue that the government collects, the federal government, that's from employment and withholding taxes. That looks like it's starting to slow up. So if that's the case, two things are you can infer from that. Number one is, maybe we're seeing a pickup in layoffs or wage cuts or something like that, because you pay taxes based on what you earn, and if the taxes are going down, the earnings are going down. That's number one. Number two, it would also mean that the growth rate in tax flows is slowing down, which means that deficit is going to expand. So more filling up of the swimming pool, which is something I like. I think that's a good thing. And you might say, well, how can it be good if wages and earnings are slowing down? Look, the market tends to run ahead of these things. I mean, we've had a big correction since January, and I think that stock market correction was, telling us that the economy was going to slow down, that job growth was going to slow down, that wages, that earnings were going to slow down. I think, it was pretty obvious that's The market was not just telling us that we're seeing that manifest in the numbers. But at the same time, you know, my concern through that period, the first half of the year, was that the tax flows were exceeding the spending. Now, if we can get those tax flows slowing down, you know, this is, like I once said, this is the ugly way to slow them down. I mean, you really want to increase the spending flows. But if they're not going to do that, at least the tax flows are slowing down, and then that swimming pool fills up even more. So that's a good thing. You got that? All right, everybody, that's it for today. Have a good one. See you tomorrow. Bye.